Hello everyone, today we're talking about crypto taxes. If you've invested in crypto, this one fact can save you or cost you thousands. The IRS treats crypto like property, not cash. This means every time you sell, trade, or even spend crypto, you could trigger a taxable event. Most beginners think, I'm just moving Bitcoin to Ethereum, or I'm buying a cup of coffee. But the IRS disagrees. Ignoring these rules can lead to surprise tax bills, penalties, or even audits. The first thing every crypto investor needs to know is simple. Crypto is property, not money. Can't stress that enough. This is important because it changes the way gains and losses are reported. Think of crypto like stocks or real estate. Every time you sell, trade, or spend crypto, the IRS treats it as if you sold a piece of property. A quick example, if you bought $1,000 in Bitcoin, later you sell it for $1,500, the IRS sees this as a $500 gain, which is taxable. Even if you reinvest that $1,500 into another crypto, that gain must be reported. Buying crypto doesn't trigger taxes, but every move afterward can. That's why tracking your cost basis is extremely important. The price you paid for the crypto is critical. Without accurate records, calculating gains and losses becomes a nightmare. Now let's go over a few taxable events. First, selling crypto for cash. This is the most straightforward. If you sell $1,000 of Ethereum for $1,500, the $500 is taxable. Second, trading crypto to crypto. Many beginners assume trading Bitcoin for Ethereum or Dogecoin is tax-free. It is not. First of all, Josh Disclosure Investments only recommends Bitcoin and Ethereum. But that's for another video. The IRS treats trading Bitcoin to Ethereum as it's like this. The IRS treats this like selling Bitcoin for cash, then buying Ethereum with the cash. Your gain or your loss on the Bitcoin must be reported. So keeping records is always the most important thing. Third, spending crypto on goods or services. Using crypto to buy a cup of coffee, a car, or even online services counts as selling crypto. The difference between the fair market value of the crypto when you received it and its value as spending is a gain or a loss. Fourth, earning crypto as income. Mining, staking rewards, airdrops, or getting paid in crypto are all considered income on the day you receive it. That amount is taxed as ordinary income at your income tax rate. Another quick tip is every small transaction counts. That $10 a coffee paid with Bitcoin is technically a taxable event. Tracking transactions, even the smallest ones, can save you big headaches during tax season. So try to keep track of everything. The more organized you are, better off. Now let's cover short-term versus long-term gains. Once you know what triggers a taxable event, the next question is how it's taxed. The IRS differentiates between short-term and long-term gains. Short-term gains are held less than 1 year, taxed as ordinary income, and rates range from 10% to 37% depending on your tax bracket. Now let's talk about long-term gains. Held more than 1 year, taxed at reduced rates, typically 0%, 15%, or 20%, depending on your income. We look at a quick example. If you buy Bitcoin for $5,000, sell it after 6 months for $7,000, the $2,000 gain is a short-term, taxed as ordinary income. Now, if we take a quick look at, if you hold the same Bitcoin for 13 months before selling, the $2,000 gain is long-term and is taxed at a lower rate. This makes holding periods important for tax planning. If you can wait a few months to qualify for long-term treatment, it can save thousands in taxes over time. Now let's quickly talk about strategies to reduce tax liability. First, use capital losses. If some crypto positions are losing money, selling them can offset gains from profitable trades. This is called tax loss harvesting. It's a simple way to reduce taxes owed on profitable trades. Second, donate crypto to charity. Donating appreciated crypto to a qualified charitable organization can help you avoid capital gains taxes and provide a charitable deduction. Third, gift crypto. Gifting crypto is giving crypto as a gift isn't taxable to you, although the recipient inherits your cost basis. It can be an effective way to pass wealth without triggering immediate taxes. Fourth, plan timing strategically. Consider selling crypto in a year when your income is lower. Capital gains rates may be lower if your total income is lower. Fifth, hold long term. Simple but powerful. Holding crypto over 1 year not only reduces taxes, but also gives potential compounding benefits. A quick bonus tip, track every small trade. People often overlook minor trades and payments, and these can add up fast when the IRS audits. Let's talk about some common mistakes to avoid. Even experienced crypto investors make mistakes. Here are some of the biggest ones. First, thinking crypto-to-crypto trades are tax-free. Second, not tracking cost basis and holding periods. Third, ignoring earned crypto like staking or airdrops. Fourth, spending crypto for goods and services without recording it. Fifth, failing to plan strategically for income years and long-term holding. A beginner buys $1,500 of Bitcoin, for example, spends $50 at a coffee shop and trades $500 for another altcoin. By the end of the year, they owe $200 or $300 in unexpected taxes. These small transactions add up over time. So record everything. You want to keep a record of every transaction made. And when tax season comes around, you will be very happy that you did. Now let's take a quick look at actionable steps. First, track every crypto transaction: buying, selling, trading, spending, or earning. Use a spreadsheet or crypto tax software. Second, record cost basis and fair market value at every event. Third, know your holding periods for all coins. Fourth, offset gains with losses strategically. Fifth, plan your sales around lower income years when possible. Sixth, consider donating crypto to reduce taxable gains. Seventh, consult a tax professional if you're unsure. Crypto taxes can get complex quickly. And a bonus, tax planning now is worth more than trying to fix mistakes later. It's much easier to stay organized throughout the year than scramble at tax time. Just remember, crypto taxes doesn't have to be confusing. Track your transactions, understand what counts as a taxable event, and plan your trades. With good planning, you can legally minimize taxes and avoid surprises. Appreciate everyone watching this video. Please hit the like and subscribe, and we'll make another video next week.